We're going to look at the sneaker company Skechers. And what I do in my videos is I run a discounted cash flow model so I could figure out the intrinsic value of the stock and compare it to the actual stock price to see if it's a buy or a sell. We also look at financial ratios and compare them to its competitors. So let's get started with the model. First, we need the market cap, and that's 4.76 billion. And that's the value of the company according to the stock market. And next we need the stock price, which is 30.22. And then we need the free cash flows. And this is how you value a company. You estimate the future free cash flows, and then you discount that dollar amount back to today's value. And that's exactly what we're doing in the video today. And free cash flow is cash flow from operations minus capital expenditures. Now I'm getting the net income, and that's a profit and loss for the business. And I'm pulling 4 years of that, and that's on the income statement. We're going to also get the revenue. So these are the sneaker sales for the company for the past 4 years, and that's also on the income statement. And you want to look at the numbers to make sure they look pretty consistent. Next, we need the capital structure of the company so we know what to discount the future cash flows by. So the interest they pay on their debt is $7.5 million, and that's on the income statement. And to figure out how much debt they have, we'll go to the balance sheet, and then we'll go to the liability section. And then the current liability shows the current debt of $72 million, and that's debt due within 12 months. And the non-current liabilities shows a long-term debt of $49 million, that's debt due after 12 months. So they pay a little over 6% interest on the debt. But since interest payments are tax deductible, let's get their effective tax rate. We'll go back to the income statement. We'll get their income before tax, that's $516 million. And we'll get their income taxes, which is $89 million. And the effective tax rate is 17%. So the cost of debt is the interest rate minus the effective tax rate, and that's 5.13%. We also need the cost of equity. So let's get the beta of the company. And the beta is the volatility of the stock, and that's 1.22. So the stock moves a little more than the market does. Let's get a little more information from the balance sheet. Let's get their current assets, and these are assets which can be liquidated into cash within 12 months, and they usually include cash, accounts receivables, and inventory, and that's $2.8 billion. And current liabilities are liabilities which are due within 12 months, and that's $1.2 billion. Let's also get their equity, and that's total assets minus total liabilities, and that's also on the balance sheet, and that's $2.3 billion. Let's get their EBIT, that's earnings before interest and taxes, or operating income, and that's on the income statement, and that's $518 million. Now we know that weighted average cost of capital, it's a blend of the cost of debt, 5.13%, and the cost of equity, 11.79%. And when you put those two numbers together, you get the weighted average cost of capital, which is 11.36%. And that's what we're going to use to discount the future cash flows. So we estimated the future free cash flows for 4 years. And we estimated all years past year 4, we call that the terminal value, that's $3.8 billion. We discounted those numbers back to today's value using the weighted average cost of capital. And those numbers equal $3.5 billion, and that's the value of the entire company. And when we divide that by 158 million shares, we get an intrinsic stock price at $22. It's trading at $30, so it's trading at a 38% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company at. They value the company much lower at $12.24. So their model appears to me more aggressive with this company. Let's look at the historical stock price. So it's been up and down over the past few years. It looks like the stock has went over 40 at one point, but it's come back down quite a bit. Obviously with coronavirus, most stocks have declined. This has come up a little bit, but not nearly as much as before coronavirus hit. The stock prices are based off of supply and demand of the market. The more people that want to buy a stock, the higher the price goes, or the more people that want to sell a stock, the lower the price goes. Let's look at their financial ratios. So they have a good PE, 13.7. That's price of stock over earnings per share. I like to see under 15. That's the median PE for the entire market, 15.4. They have a price to sales ratio of 0.9. That's really good. I like to see under 2 in a company, and the average in the market is 4, and the median is 1.8. They also have a pretty good price to book, 2.1. That's price of stock over book value per share. That means investors are willing to pay $2.10 for $1 of book value. Good current ratio, 2.3. So they have a decent ROE, 15%. That's income over equity. Interest coverage ratio, no problem. They can cover their interest 69 times because they don't have much debt in their capital structure. Only 5% is debt. The other 95% is equity. The best way to look at ratios is against competitors. So we have Foot Locker, Nike, and Skecher. So if the number's in green, that means it's better than the average. And if it's in red, it's worse than the average. So they have a better PE than the average sneaker company, 13.7, average is 18.5. Better than average price of sales, 0.9, the average is 1.7. Foot Locker is the best in those categories. Price to book, they're 2.1, the average is 6.8. Nike seems to be the worst in those categories. And they're all in good shape in terms of current ratio. They could all cover their current liabilities at least twice. ROE, Skechers is worse in ROE. Nike is great in ROE, 48%. But ROE can be timing. You have to look at it over multiple quarters as well. Skechers and Foot Locker are only 5% debt. That's really low. Nike is also pretty low too at 28%. So that all the companies don't use too much debt. And Skechers is in the middle in terms of market cap. They're 4.8 billion, but still much smaller than Nike. So thanks for watching the video. Leave some comments. Let me know what you think. If you have more additional questions, talk to you soon.